Hey traders, this is Blake Morrow with Trader Summit, and with me today is Jim Welsh from Macro Tides. It's always nice to talk to you on a Friday. How you doing, Jim?
I'm doing good, Blake. And hey, as you just noted, it's Friday, so we all should be doing better.
Yes, right. Especially now that we're past the speech from Fed Chairman Powell at Jackson Hole. Let me ask you this. Obviously, today was a big day for the markets. We were all kind of waiting for it. Those of us that are the three or four of us that are actually trading around August that are here, we were waiting for it. We got his speech. What did you learn from his speech?
Well, me personally, very little. I think what's happened is that a lot of market participants have been listening to CNBC the last few days, and Steve Leisman has been talking to a number of the Fed presidents who were very vocal about their belief that the Fed needed to start to taper soon, aka September, and actually begin tapering in October, with a couple of them like, no, we shouldn't go 10 billion, we should do 15 billion. In other words, instead of 12 months of tapering, 8 months of tapering, which will then, open up the discussions, if you will, sometime in mid 2022 for rate hikes. So I think if anybody was listening to CNBC, you would think, well, maybe there's a real chance that Powell will say something a bit more hawkish. And in fact, he didn't. He said all the things that I thought he would, that, okay, we've hit our inflation goal. We've made progress in terms of the labor market, but we're not quite there. Delta poses a risk. Inflation is going to be transitory. These are all things that he has discussed before and mentioned. Now, the one thing he did say, which I think is somewhat significant, is that he said at the July meeting, he agreed that we had hit our inflation target and that we should begin tapering before the end of the year, which he said most participants agreed with. So in my mind, Blake, as we've talked, I thought November was the most likely meeting. I still believe that. I think they will use the September 22nd meeting to tee up more specific and actual launching of tapering at the November meeting. So to me, that's the one big takeaway. But I think for a lot of market participants, if you've been listening to Fed presidents, you might think, well, there's really a chance he may say something. And I just didn't believe that was likely. And again, those people that we've been talking, none of those Fed presidents are voting members this year. And I think that's a real key thing. People have to pay attention. Who's talking? Is he a voting member? They'll express their opinions, but it's a lot more emphatic if they express an opinion and then can cast a vote.
Yeah, that's a great point. And when you hear like these Fed governors and you hear them speak, having a spreadsheet is actually beneficial, especially at this point, at this stage in the game.
Yeah, I mean, I've included in a number of letters a layout of the Dove versus Hawk spectrum and who votes in 21, who votes in 22, and I think it actually goes into 23. You can't tell the player without a scorecard. Yeah. And so to me, that is like an essential thing to have at your disposal because it's just really informative.
Well, that's something that you put together in your newsletter. Now, last week, you were pretty dovish on the dollar, or dovish. I say dovish on the dollar. You were more bearish on the dollar, thinking the dollar was going to pull back a little bit, and it has, and rightfully, it's gone to what you thought the dollar would pull back a little bit. But where do we go from here? Do we have any further to fall? What do you think about the dollar where it's at currently?
Yeah, my guess was that the pullback to 92 is, I think, really very likely. And I think there's an outside chance 91.50, which would be about a 50% retracement of the 4.2 points of rally the dollar had off the May low. So I think that's possible, and that could have some implications for gold in the short term as well.
Yeah, it sure could. I mean, the gold gold market just climbed above pretty big resistance at the 200-day moving average, and then we're getting close to. And let me make sure I've got this number correct as I pull it up on my screen really quick. We have the 618 Fibonacci retracement from the highs in May to the spike lows, that spike low that we saw, that crazy fat finger low. The 618 retracement comes in around 1825. What level are you looking at in gold?
I'm looking, I mean, that is a number of, you should know. At the same time, you can see that there were a number of days where the gold traded between 1830, 1835.
Yeah.
So that has been the area I've been focusing on, that it needs to close above 1840. Because then all of a sudden you're clearing some overhead resistance, which I think then leads to a move up at least probably another $40 on gold.
That makes a lot of sense. And I think you'll have a lot of people starting to scream, oh, there's a double bottom. Maybe we see it a little bit more constructive. Now, we've seen stocks, they're going to close at all-time highs in the S&P. Where do we go from here? I mean, I know, it's like every time the market surges to new highs, since we're developing this technical wedge, it's like if you get caught chasing the market higher, it's not, you can get caught, right? But, can we stretch our legs here, especially if you see the dollar continue to sell off, you see gold, other commodities maybe stretch their legs higher. Is that the tide that lifts all boats? What do you think?
Well, yeah, I've been focusing, Blake, on looking at the cyclical sectors, because the problems that I have seen in the market is the advanced decline line, the number of stocks making new highs. So you had this concentration of mega cap stocks pulling up the Qs, pulling up the S&P. And last week when the S&P was making new highs, the Russell was 6% below its prior high, and the AD line was weaker. So those are all normally telltale signs of vulnerability and a presage to a 5 to 7% correction. So I've been in that camp. What we're seeing today, and what I want to see is follow through, because we have seen this before, is breadth is terrific. The Russell's up, I think, about 2.5%. And some of the cyclical sectors are getting close to breaking out. In other words, trend lines connecting their highs from earlier in this year. Yeah, they're getting close to breaking out. So for me, that has been the make or break determinant in terms of whether we're starting the next leg up or not. If this move had happened in the cyclical stocks without news, it would have, to me, more justification and carry more weight. So I want to see what happens early next week before I abandon, if you will, the expectation. We're in a bull market. I felt we'd have a 5 to 7% pullback and then move to new highs. So it could be that, hey, what's going on right now, the internal corrections that have taken place, and now the cyclical stocks are ready to kick in. That could be enough.
So now I'm going to take us right back to Jackson Hole really quick and about wrapping up, what the Fed chairman said today. Does that make next week's jobs report more important for, thinking about what monetary policy may be?
Yeah, absolutely. It does. At the same time, even if we get a pretty good number, let's say north of 700,000, that isn't going to meet Powell's requirement of fulfilling the labor market mandate. All right. There has to be a series of numbers, but does it, increase and almost solidify that they will make an announcement or tee it up at the September meeting? Yes. And the other thing is COVID. We need to see Delta cases starting to come down. Members of the Fed, including Powell, don't expect Delta to really derail the economy. But obviously, if we start to see cases come down, and the stuff I look at suggests that we're peaking right now, and there could be a 20 to 30% decline in cases by the time the Fed meets on September 22nd. All those things, I think, weaken the dove's hands and allows the Fed to truly tee it up at the September 22nd meeting.
Awesome, Jim. Well, I want to say it's always great to talk to you on a Friday. One of the things I love most about your analysis is you marry both technical, what you see on a chart, with a macro backdrop, hence macro tides. I love your work, and we appreciate your time every Friday.
All right, Blake, thank you so much. Enjoy it, and you have a wonderful weekend.
You do the same. And guys and gals, make sure you give us a thumbs up if you like this type of content. Subscribe to our YouTube channel, and also click on the link below to get to Jim and figure out how you can get his newsletter as well. So Jim, thank you so much once again.
Thanks again, Blake.